Dealer gamma exposure, or DGE, is a key concept in options markets that reflects how market makers or dealers are positioned with respect to their exposure to gamma, one of the Greeks that measures the rate of change in an option's delta relative to the price of the underlying asset. Gamma refers to the rate at which an option's delta changes for each $1 move in the underlying asset. Delta measures how much an option's price moves for a $1 change in the underlying stock. Gamma measures how the delta changes as the underlying stock moves, making it the second derivative of the option's price with respect to the stock price. Dealers, or market makers, provide liquidity in the options market by selling or buying options. However, they often try to hedge their positions to remain neutral and avoid taking directional bets on the underlying asset. To do this, they adjust their stock positions based on the delta of the options they hold or have sold. This is called delta hedging. Understanding dealer gamma exposure. Dealers hold options inventories as a result of their market-making activities. Their exposure to gamma can have significant market implications, especially when the market moves. Here's how it works. Gamma and delta hedging. When a dealer is long gamma, the delta of their options positions becomes more sensitive to changes in the stock price, but in a stabilizing way. Long gamma means that if the stock moves, the delta of the option will move in a way that allows the dealer to buy low and sell high. This leads to less aggressive hedging as prices change, helping stabilize markets. Short gamma means that delta will change in a destabilizing way. If the stock price rises, the dealer will need to buy more stock to stay delta neutral, pushing the price even higher, or if the stock price falls, they need to sell more stock, pushing the price lower. This can accelerate market movements and increase volatility. For example, if the dealer is short gamma, they are more likely to chase the price up or down by buying into rallies and selling into dips to maintain their hedges. Impact of gamma exposure on market behavior. Positive gamma exposure, long gamma. Dealers are long gamma if they have net bought options, such as when they hold more long calls or long puts. In this case, when the stock price rises, the delta of their positions will increase and they will need to sell stock to maintain a neutral position. Conversely, if the stock price falls, they will buy stock to stay neutral. This results in a stabilizing effect on the market. Dealers are buying on dips and selling into rallies, which can smooth price movements and reduce volatility. Negative gamma exposure, also known as short gamma. Dealers are short gamma when they have net sold options. For example, they've sold more calls or puts than they've bought. When the stock price rises, the delta of their short positions increases, requiring them to buy more stock to hedge. And when the price falls, they will need to sell stock to hedge. This can create a destabilizing effect on the market. Dealers are buying into rallies and selling into dips, potentially amplifying price swings and increasing volatility. A gamma squeeze can occur when market makers or dealers are short gamma and the underlying stock begins to move sharply in one direction. If the stock price rises, for example, dealers must keep buying stock to hedge their short gamma positions, pushing the price higher. This can lead to a feedback loop where the price continues rising as dealers buy more stock to stay delta neutral, accelerating the upward movement. The infamous 2021 GameStop short squeeze was partly driven by this dynamic, as retail traders bought call options, forcing market makers to buy the underlying stock, pushing prices even higher. The effect of gamma exposure is particularly noticeable during certain market conditions. Near expiration, as options approach expiration, the gamma of at-the-money options increases, making delta more sensitive to price changes. Dealers may need to hedge more aggressively as the stock price moves. High options volume. When a large number of options contracts are traded, particularly around key strikes, dealers' gamma exposure can be significant. This may increase the magnitude of their hedging activities, impacting stock price volatility. If volatility is low, dealers might be long gamma, and their hedging actions will help stabilize the market. If volatility spikes and dealers are short gamma, their actions can exacerbate price swings, increasing volatility further. Long gamma dealers are hedging in a way that stabilizes the market. They buy when the stock price falls and sell when it rises. Short gamma dealers hedge in a way that amplifies market moves. They buy when the stock price rises and sell when it falls, potentially increasing volatility. Gamma squeeze. When dealers are heavily short gamma, sharp price moves can trigger a feedback loop, leading to large, rapid price movements. Understanding dealer gamma exposure helps explain how options trading activity can influence stock price volatility, especially during periods of high market activity or around key expiration dates.